Welcome to the Voice of Insurance. I'm Mark Gagan. One of the perks of this job is being able to access some of the smartest and nicest people in the sector and introduce them to you. These are the sort of people that us journalists turn to when we need a new perspective to help us see the big picture or work out what is really going on behind the scenes. They know a huge amount, and they also have access to all corners of the market. They speak clearly and plainly, and are also kind enough not to mind journalists asking them a bunch of silly questions. This episode is just one of those opportunities. Andrew Newman and Printhan Sothinathan of Willis Re are two very smart, very senior, and very engaging figures in the reinsurance market. I caught up with them just as Willis Re had released its Covid-19 report. This report is the most comprehensive and far-sighted produced by any market participant to date, and I recommend you take time to read it, 70 pages. I'll put a link to the report in the podcast notes. Anyway, stay safe in lockdown and enjoy this incredibly wide-ranging and hopefully mind-expanding encounter. I know I certainly did. Before we get started, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high-quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The report describes the risk from COVID-19 business interruption as an existential threat to the entire industry. Can you explain sort of how you came to that conclusion? Maybe Andrew.
So I think context is important, and I think it's worth making the point that it could be an existential threat, largely driven by the interference of legislative oversight and political interference on policies that change the coverage that actually existed into something that didn't exist. And so when you add up the total insured limits on the property side, which are huge, and you consider that this is a threat that has global dimensions. It's not like CAT that's regional and non-correlating. You very quickly get up to numbers that exceed the capital and surplus of the insurance industry. So that's where we came from. It's not meant to be a hysterical assessment that insured losses will present an existential threat. The operative word there is could.
And do you think it's a kind of zero-sum game anyway? If politicians, for example, did decide to have retroactive cover and collectively bankrupt the entire insurance industry, then presumably they might realise that they would have to bail the whole insurance industry out, and they'll be back where they started. Do you think it's likely?
Do I think some interference is likely?
Kind of some forcing of retroactive coverage.
I think it's too early. I think there are lobbyists who be better informed than me. But I think you hit the nail on the head, which is that it's a nice soundbite to say we'll get this pool of capital to respond, but there isn't enough capital in the industry to respond to what they want to. So could there be some compromises in terms of supervision and rate increases and things like that? Possibly, but I do think it's a zero-sum game because it all bounces back to the state at some level anyway if they do that.
What's developed this week, certainly in public pronouncements, I've had John Neal and various others to say that it probably is right to assume that the COVID-19 loss is going to be the largest insured loss event in history. Would you be agreeing with that?
I certainly think it has the potential to be the largest insurance event. Whether it's the largest insured loss event, I think there's some uncertainty. But what's interesting is you've got impact on the asset side of the balance sheet, which at its nadir during the first quarter was 20% of capital. It's rebounded since then, but we've got a lot of the year yet to go. And in terms of nominal insured loss dollars, I think that's perfectly plausible that it could be the largest insured event. But I do think it's worth thinking about what was the impact on capital of the 1908 San Francisco earthquake? What was the impact of insured loss after 9/11 on the then capital? And I think that sort of equalizes things out a little bit. But I think we're sort of sharpening the blade here. It certainly has the potential, I would say, likelihood of being a very significant event for the insurance industry.
Okay. In your report, you mentioned sort of the four main effects. Obviously, we've got the asset side effect that you've already mentioned. The asset side hit to our balance sheet. The liability, obviously, we've got the liability side, which is fairly obvious and apparent and developing. We've also got existing adverse prior year development, which was just really starting to manifest itself as before all this happened. And also we've got the GDP-related hit to all of our income as economies slow down and risk units are diminished going forward. Out of those four effects, I wondered if you had to place a bet on this, which do you think would be the most painful to reinsurers?
So I think from a reinsurance point of view, what you really got to consider is the differentiated strategy that all reinsurers have. So all of these four issues are going to manifest themselves to reinsurers in differing ways. And really, it's not yet clear what the landscape is. It's continuously evolving. I think if you were to ask the community maybe 4 weeks ago, they would have come to you with a different set of answers than the ordering that we would come up with today. But also it really tests the resilience of reinsurance strategies. And so, one reinsurer that has a different portfolio from another reinsurer is very much going to get affected in a different way. But at the crux of the issue, I think what it comes down to, it will be capitalization and the strategy behind capitalization of different reinsurance groups, their size and their dominance in specific areas, the nature of their portfolios. So for a reinsurer that is considering the property and casualty business on a commercial lines aspect will be affected differently from a reinsurer that has a live portfolio on their books, or reinsures a large segment of the health insurance market, or indeed personal lines. And I think once you get into those issues, you'll see a wide array of differing reaction. And I think there's also, and you have to add to that regional nuances as well. So different sections of the globe will behave and react in a different way. So it's really hard to say, to answer your question, it's really hard to rank whether the GDP hit to income is going to be more substantial to the community as a whole than adverse prior year development, because you have to get down to the specifics. But quantum-wise, to Andrew's earlier point, this is a seismic event, even in financial terms, looking at the asset side of the balance sheet. And so it's kind of more of an impact from both the financial impact globally on an economic basis, as well as the loss impact and how it might affect losses. I know that's not an answer in terms of ranking, but it's hard to give you one without being specific.
Yeah, for some context on the asset side, obviously the last big asset hit we had was in the global financial crisis, 2008, 2009. Currently, we're not as bad as where we were. I think I recall we were probably about 10 or 11, 12% by the time we added up all the numbers back.
It was close to 15, I think, actually.
Yeah.
Close to 15, yeah, and very asymmetrically spread as well. There were some reinsurers who were much more severely affected because of their investment portfolio. But yeah, we were there at a point in time during Q1, but it's leveled itself out towards the latter part of the month. So, as I said, it was minus 20, which was probably slightly worse than we saw in the GFC, but has improved for the balance of the quarter.
Okay, probably
still got 3 quarters to go then.
Yeah, absolutely. Yes,
I think, building on what Printhan was saying, I think the 1-2 punch of the asset and the liability side is probably where we would say you probably want to focus. I think the existing prior year development, and we've just working on some analysis at the moment. I think the statistical view of prior year development on some casualty lines is probably 10 billion. You're looking at 3 times that in terms of capital impairment on the asset side. And the GDP related hit, it's not really a hit. You don't get hurt by stuff you didn't write. And people will say that you change the denominator, that affects the expense ratio, but it's not a hit. It's just something you wished you had. Prior year development is a hit. Asset side volatility and how that flows through the balance sheet, that is a hit. So I think, for instance, we'd probably say asset, liability, left hook, right hook,
exactly.
And prior year development, probably a distant third, and the GDP related hit, we kind of don't see as a hit.
Is it bad for you?
Does that make sense?
But it affects your ability to trade through, though. If you're stuck with old liabilities and now you've got 20% less income because the global GDP is contracted by 15 to 20%.
Yeah. So it's an amplifier rather than a factor. It amplifies the problem, but it isn't the cause of the problem. The cause of the problem is the 1-2 hit on the asset and the liability side.
Okay, we were talking about capital. We've got big renewals coming up, particularly relating to the North Atlantic hurricane season. So going into that season, how well capitalized is the reinsurance market today?
Well, I think it's sort of 95% as well capitalized as it was at the beginning of the year is the glib answer. I mean, if you look at the analysis that we shared, what the industry's shock absorbers, capital shock absorbers have done is avoided a punch. And yeah, there's a hit to capital, but the rating agencies are yet to pronounce, but it doesn't look like the industry position has been seriously dented. Obviously, the loss picture hasn't flown through yet. It'll be interesting to see how Q1 returns and the losses develop over Q2. But on the surface, the industry looks as if it has coped with these well, and the excess buffers have done what they should have done. And to some degree, Mark, those who railed against regulators and rating agencies saying, we need these excess capital buffers, and those who countered it saying excess capital's the bane of returns and investors have probably been proven to be right.
Okay, so capital's sort of there, but obviously there's a massive psychological effect on everybody, on their risk appetite. So what's your assessment of reinsurer risk appetite going up to, now going into Florida renewals?
Yeah, so I think the appetite going into the Florida renewals will be the first true test of the reinsurance market following the recent events from COVID-19. And actually, it will be somewhat of a reflection of exactly what reinsurers believe today. But a lot of it is going to depend on the primary insurance market themselves and what they traditionally rely upon in terms of dependency on reinsurance structures that help them trade through the year, their own capitalization and liquidity, and how much of the cost that they can pass on to their customer base who may not be willing to pay that. And so I think there's going to be a trifactor that effect of reinsurance purchasing and what that looks like. But really, it's going to vary again, company by company. And it's also going to bear a reflection on how much risk reinsurers are willing to onboard at this stage of the year for 2020.
Are Florida cedents facing something of a perfect storm? They've had loss deterioration on the large loss events. They've got a very litigious environment. It's also difficult to put through original rate increases. And now they're presumably faced with reinsurers that are going to want more money one way or another. Andrew, how are you going to approach those difficult conversations?
So I think they've already started. I like the headline of a perfect storm for Florida carriers, but the conversation has already started. You're absolutely right to make the point that, and I think this is not specifically about Florida carriers, but if you have been highly leveraged and your business model is highly dependent on external risk finance, then to the extent the price of that external risk finance and the availability of that external risk finance moderates, there's a squeeze. There's an inevitable squeeze. And it's also true where the market sells instruments that work on an occurrence basis that aren't back to back with the original policies. It's also the case that there's some transitional issues that can happen when coverage disappears. So are they facing a perfect storm? I think they've got to continue the metaphor, lots of headwinds. And I think one of the things that Printhan was saying, which is absolutely right, is one of the challenges for reinsurers with this event unfolding is to what extent in a year of balance sheet adjustment, witting or unwittingly de-risking the portfolio, to what extent do you feel it prudent to make an outsized bet on a natural peril that will probably peak during Q3, Q4 of a year that is also going to see some loss emergence and some volatility in the market. So there may well be a sort of an outer limit in terms of how much risk reinsurers will take. I wouldn't say irrespective of the premium, but I think their appetite will need to be whetted differently than it would have been if what was happening now was happening in the absence of COVID-19 and everything that was taking place. So perhaps in the final analysis, my hope for Florida is that it's important that reinsurers understand that these organizations played a very important role in facilitating access to private capital into the state, and for them to participate in what over the longer period has been a very important part of many reinsurers' CAT portfolio. Difficult recent trading conditions, but over the longer term, they're important. And my hope is that if capital is in short supply, that they discriminate, because the good ones really do need long-term support. And there is quite a wide spread between the performance of those companies. And my hope is that reinsurers differentiate rather than take an across-the-board position. And that would be the right and efficient thing to do.
What you're saying is that a bit more rate, and then that will get them to do a bit more.
A bit more rate might not get them to do a bit more. That's what I'm saying. I think that you have some sympathy with people whose balance sheets might have been impacted over the last couple of quarters, imagining how much risk do they want to take in the third and fourth quarter of 2020, irrespective of rate. I don't want to sort of portend that there's going to be a major crisis in Florida yet. I'm just saying that COVID-19 has had an effect in revealing the strains that exist in a leveraged model that is dependent on external risk finance, when the price of that finance and the availability of that finance is curtailed. And the reason it's curtailed is because I think there will be some reinsurers are saying, CAT isn't infinite. You can't just keep on accumulating it. So irrespective of price, there's like a natural boundary beyond which you can't go. And is it the case that reinsurers will be resetting those boundaries in Q3? It's too early to tell, but it's possible. It's certainly going to be, I think, the sort of the most challenging market conditions we've seen in many, many years. There are some placements that are out in the market now. There are discussions taking place. I don't think anyone's that's involved in this market is going to be listening to this podcast and thinking that what I've said is an epiphany. I think this is exactly what the market is working out now.
Yeah, and I think to Andrew's point a little bit further is that it's not only the cost of capital that's going to influence this discussion, it's the availability of capital. And I think right now, it's going to be very challenging to access new, fresh capital whilst the entire financial community are struggling to understand the effect of COVID-19 on total portfolios. And so it's just as much of an issue of cost as availability, and availability that will drive cost even further. And I think that's what the key issues are going to be for emerging for 2020. As the full extent of COVID-19 fully develops, I think once concerns ease and capital markets make themselves accessible again, we might see that part of the equation is short-lived. For the time being, there's going to be issues accessing capital.
Yeah, it's probably an appropriate time to be talking about the higher end of the reinsurance, the retro and ILS and alternative capital providers. In your report, you mentioned about some multi-strategy providers of capital. Of course, at the moment, they've got bigger fish to fry. It seems that they've got very, very high, presumably high risk, high return games to play in other capital markets, presumably in corporate bonds and other places where they can get potentially fantastic returns. So at the moment, does it mean that reinsurance or catastrophe risk is relatively unattractive at the moment in terms of if you've got all these many different strategies that are ongoing? Is it not really these guys' top priority, that they've got far better prospective returns in other classes? I mean,
other classes, many of whom will correlate in the tail. And I think insurance as an asset class will have revealed itself to be delivering the diversification that it promised. And that certainly seems to be what is happening now. And there is great value in diversification to money managers. So I don't think it's quite as simple as there are opportunities elsewhere. There are, but to the extent they all correlate in the tail, then what that sort of curtails one's appetite to want to allocate in all those spaces. I think on the retro side, the retro ILS side, whatever the trapped capital issues were going into the year have been amplified. I think whatever the availability of capital into this has been amplified. The challenges have been amplified, but for the fact that I think thus far insurance assets have performed extraordinarily well in terms of diversification. And I wouldn't underestimate the value of that. I think uncertainty over what's covered and what's not covered, and the sort of move away from named perils to all perils and UNL. I think investors are quite naturally thinking that maybe, given experience in the last 3 years, many of the losses exceeding model estimates, coming from perils that were hard to model, but probably not as comprehensively modeled in hindsight as was necessary. I think there'll be another hurdle to overcome with investors, which is what are we actually responding to, and are we pricing for it? So I think all of those things need to play through. I think they will play through. And I think we will see retro as an even more challenging market than it was destined to be. I mean, it wasn't like last year was a walk in the park or a cakewalk. So all of the factors that you've alluded to will have an effect on supply and demand. And if you think about it in the context of balance sheet compression, there should be more demand. I mean, carriers, as we said in the report, have unwittingly woken up at the end of Q1 holding more risk than they anticipated when they went into Q1, and it's got nothing to do with losses. So we also recommended that they make some forward-looking analyses and start looking at the impact of balance sheet compression against a range of scenarios and run their capital models so that they can make the decision that needs to be made, which is, I'm happy with that additional risk in the portfolio, or I'm not happy with it and I choose to either hedge it or reduce it. But you don't want to do that going into the beginning of the year, and you don't want to come to that conclusion when you're doing your returns. So, and I think most companies are already doing that. So I think we could see, out of all of that, we could see retro demand go up. We could see retro supply go down. And I think capitalism is a great equalizer. And I think what will happen is that capital will flow, but the terms on which it flows, the coverage for which it's prepared to respond, and who it aligns with are all yet to be determined.
Currently, are most reinsurers confident that their retro will be picking up back to back with them on BI exposures that are related to COVID-19, for example?
Yeah, I mean, the thing with retro is you're dealing with the most sophisticated part of the value chain in terms of knowledge. So if they think it's covered, it will be, and if they don't think it is, they probably know why. So I don't think there's going to be a huge amount of uncertainty in terms of basis risk of the products they bought. I mean, they know what they bought, so I don't think there are going to be too many shocks.
Okay, well, we're talking about, I suppose, a time to be cautious. Reinsurance in its most fundamental guise is capital. So you're talking about potential for an increase in demand for retro. What about just fundamental across the board demand for reinsurance as seeding companies think, well, I should buy a bit more quota share. I should give myself some capital relief by just buying more insurance this year. Do you see that happening?
I certainly see it being part of the armory that's available to them. I mean, what we're talking about is the consequences of balance sheet compression and the need for additional external risk finance. Now, it doesn't have to be external risk finance. You can get internal risk finance. You can, and there have been examples of rights issues and equity offerings, and I'm sure there will be debt equity instruments that organizations will look at to help them deal with any additional capacity they may need or additional capacity they may want in order to take advantage of improved market conditions. Reinsurance is only one of them. And I think because of the fluidity of capital and the various instruments that are available to people to sort of source external risk finance, there's a bit of a comparison and a bit of a ceiling in terms of how far things will move. There's a point at which reinsurance, the non-recourse instrument of choice, becomes actually really expensive if ceding commissions plummet and loss ratio caps are put on and the box is so tight that actually you might as well go and raise some traditional equity or debt equity to replace it. So I think behind your question is, do we think there's going to be a need for additional risk finance? Yes. Will reinsurance play a role in that? Yes, it will. It will.
And do you think currently, the way that everything's stacked up, that reinsurance is still going to be an attractive purchase? It has been an attractive purchase in the last, decade, particularly for cedents. And do you think it's going to continue? It will be able to maintain those economics to be attractive versus other forms of capital?
Yeah, I mean, I think the economics have to improve for the sellers, but they also have to work for the buyers. And our advice to clients is to make sure you don't get trapped and get on the wrong side of that, and you've got time and the ability to make sure that you can navigate in control of your strategy rather than a sort of a victim of a poor strategy. But no, I mean, I think reinsurance has acquitted itself absolutely fantastically over the last 10 years. I think there is probably a price correction that is necessary for reinsurers. Their cost of capital has gone up, their margin requirements have gone up. I think it's unrealistic to assume that reinsurance capital is going to be made available at less than cost and with not decent returns. But I think I think demand for reinsurance will be the natural port of call. Its response has been phenomenal. I think the behavior of reinsurers thus far has been really pretty good. And so, yeah, I do think there's going to be an increase in demand. And I think we, like many other people in the market, have to help satisfy that demand by working on supply.
Okay, so we're coming up to renewals. Your report mentions, this is COVID-19 is now a known event. You said in reinsurance terms, it's a bit like having had a hurricane already made landfall. It's like a live cat. So given that, is it fair for reinsurers to be asking to exclude COVID-19 as of the nearest available renewal? And what are the practicalities around that? Also, your report did say that generally, if cedents were able to show that on the original risk they were excluding, that reinsurers were happy to follow them and not have to slap anything on the reinsurance contract that was exclusion. Do you think that's going to continue going forward, say particularly for 1/6?
Okay, so I think fair is probably the wrong word. Do I think it's appropriate for reinsurers to be listening to clients who can make coherent cases that what they're doing is reasonable and doesn't expose them to an amplification of a known loss? Absolutely. And I think they will, and they do. There's no doubt about that. There are people who have given affirmative coverage for some time. They've managed it in a particular way, and it's contained and narrow and walled off. And I would continuity to be extended there. I think if insurance is about distributing fortuitous loss around a large risk pool, to expect somebody to continue to make available and expose their capital to a known loss probably has some outer limits to it strategically. So I do think that's going to be an area of discussion. What I think does need to be considered, and we're talking about instruments where time and relationships are super important. I mean, reinsurance still is an instrument where time is of economic value both to the buyer and the seller. So we should look at these things over a longer time horizon than the 3 or 4 days leading up to the renewal of a particular instrument. I think if reinsurers' position is we don't want to expose a second set of limits given the complication of these events, I do think there is a discussion to be had about how they support clients when they wind down their exposure and deal with the runoff exposure that clients will be faced with a sudden reduction in the availability of, say, CAT. So I think fair is an emotional term. I think it is perfectly reasonable for clients to expect to have a debate with their reinsurers. I think it's perfectly reasonable for reinsurers to make the point that, given the accumulation may be falling to them, they don't want to pour gasoline on the loss and continue to amplify it and open up a second set of letters.
You mentioned,
but I don't think it's that simple. There is runoff to be dealt with.
Yeah, you mentioned different classes. There are some classes that you said in your report, that some classes that it seems to be, it's clear, everybody knows it's clear that we should have exclusionary language because we know that this class is never intended to cover pandemic risk. Right. And there are others where not, and you mentioned perhaps in employment liability. I was wondering, for example, what about situations where, perhaps there's a moral obligation to continue cover where it was definitely intended, and what about particularly on original policies that are on a claims made basis, for example, as well, where we know that the event has occurred but the claim may not have been made, and we don't want to end up with a situation where there's effectively retroactive date inception for some of these things.
I don't think that's a reinsurer's issue. I think that's an insurer's issue. I really do. I mean, I think how do you deal with the intricacies of a known event, and then you get into all sorts of interesting arguments about direct versus indirect, and I don't think that's a reinsurance issue. I think that's an issue the reinsurance industry is keen to understand, but I think that issue is one that should be addressed to the insurers who are dealing with those issues on claims made policies, on occurrence policies. When was the occurrence? I mean, I think it's an insurance issue. The reinsurance market does a pretty good job of following the fortunes. Quota shares follow, and excess of losses generally follow too. So I think it's an insurance issue. It's a big issue, but I don't think the reinsurers will steer the bus there.
Okay, what about, we've been talking about risk appetite generally. This has been we could describe this as a black swan event, or frankly, it was just a swan. I mean, we've known that pandemic risk exists. It's a white swan, frankly, but we can argue about that until the cows come home. But has it woken up reinsurers to other known unknowns or other potential black swans, things that we've also been talking about quite a lot, for example, like other potentially systemic risks like cyber, for example? Has it woken them up to sort of, risk awareness around other things? So you find that you're getting lots more queries from reinsurers about what exposures they may be in for.
First of all, let's go to the point so the black swan part of COVID-19 and how it's manifested itself is effectively, I think the industry as a whole considered pandemic exposures and have long time been doing that since SARS was around and even before that. So I think they have always considered pandemic exposure, but I don't think anyone anticipated appropriately or to the extent that it should have the global effect of the actions taken by governmental authorities to shut down parts of the economy. And I think the correlating piece of that action, as well as the pandemic spread and the epidemiology of an unknown virus at this time now, I think that's the kind of the accumulation of those things, and the effect of it is the black swan. And so I think reinsurers will be considering, and insurers will be considering, how they consider correlation of certain systemic issues and what the potential consequences of those will be. So I think the industry is also very good at looking at unknown unknowns and understanding or trying to quantify or trying to make sure that their capital is resilient enough to react to that situation. And if you look at the industry today and reacting to this significant once in a lifetime event, it's still here and it's still functioning. It's still paying claims. There is some functionality in terms of how it's going to trade forwards. There's access to capital and they're thinking that through. And so, I think the industry has been quite thoughtful around this. Are there always going to be factors that are going to arise every decade that haven't been considered to the extent that they should have? Of course there will be. But, I think the industry has a good way and a good framework, risk management framework in place to continually assess emerging risks.
What about going forward? We've had announcements this week. We've had Stephen Caplin and other luminaries in the industry. In fact, I think somebody from Willis Re as well, looking at potential pandemic re in the UK. How insurable is pandemic risk now that we know a lot more about it and about how systemic it is globally? And do you think it will have to be a public-private type solution?
So I think there's two pieces in that. So pandemic risk, I think if you look at it, I think the characteristics of having an insurable event, it definitely fits that bill. And the quantification of that, I think we're becoming more and more acutely aware of. There's a lot of science behind this, and there's certainly a lot of factual information that presents itself. There's going to be experience that is going to be drawn upon. So I definitely think that pandemic should be an insurable event. How it occurs and the quantification of the effect of pandemic and how it spreads regionally, I think those are things that we need to study more thoughtfully. And definitely the private public sector should be involved in that. And there's an element of public sector that should definitely be involved because of the systemic nature of pandemic consequences. And to keep financial systems alive and running, the reinsurance is a valuable part of the kind of macro financial mechanisms to keep global economies running. And so I think from that perspective, yes, reinsurance should be part of that conversation with governmental authorities and the like. And certainly pandemic should be an insurable issue.
I mean, I think if you think of insurance as, the bookmaking analogy is inelegant, but bookmakers run books, not entirely concerned about who wins. They just want to balance the book. And insurance is a lot more sophisticated than that. But to continue the metaphor, the problem, what the insurance industry does and the reinsurance industry does in particular is it sources lots of non-correlating pools of risk, which it funds extreme outcomes in any one or two with the fact that not all of them will go. To use the bookmaker analogy, what we're experiencing at the moment is 7 winners all coming home in the same race. And I think it reaches a point, in principle, I don't know whether we're there yet, but in principle, where when you can no longer spread a threat, a pool of risk across the capital base in the insurance industry, and terrorism would be a good proxy in the US. It absorbs what it can, and it plays a very effective role in quantifying risk and pricing risk and providing guidance in terms of risk management. And the insurance industry does a really good job at that. And it does a really good job at working out target versus non-target and what's high risk and what's low risk. But there comes a point with a certain type of threat, and maybe pandemic is one of them as it affects multiple lines of business. You can't balance it with anyone. And the risk that would otherwise revert to the state if the insurance industry said we can't insure it goes into the state at $1 rather than at, say, $200 billion. And I think, you mentioned the group. I think Stephen's leading an initiative with Julian Anoitzi, and I think he's got the right people with Aon and Marsh and Willis. James Ken is our representative on that group, but he may have others on it, because that group has the experience of looking at pools of risk and how that can be financed by the industry. What is the impact in terms of the overall industry, and at what point can we take the pain without ending up writing checks we can't cash? And I think it's absolutely the case that that initiative needs to be supported. It's got some great brains on that group, and I'm sure it will come up with some good recommendations. And we all saw the Marsh letter. I thought it was a very, very well set out letter as to how the industry can play a role in financing this new threat that very few people thought of.
Do you think a useful thing about the insurance industry, of course, is it is a useful conduit for, if it ends up being state aid in some form or another, or state relief, then the insurance industry already has the existing infrastructure to pay claims.
Yeah, in fact, I had that conversation with somebody the other day, which is if what the politicians wanted was a medium by which claims were allocated, I think government departments would struggle to adjudicate business interruption losses. They're complicated for experts. The industry has the capability of doing that. What it shouldn't be forced to do is to actually sign the checks when the coverage was explicitly excluded for the reasons I said earlier on. But I mean, if there's some role the industry can play in facilitating the distribution of cash from the state to various individual enterprises, I can't speak on behalf of the industry, but I think it would be willing to do that. What it can't do is be bullied into changing coverage that was specifically excluded into one that politicians wished had been available.
There's only one question that I didn't ask that perhaps I should have asked earlier, was about, we've had some reasonably high profile returns of premium from, this is probably mostly personal lines insurers. This is on both sides of the Atlantic, for fairly idle classes like personal auto, for example. Some return premiums there. Are reinsurers being good, pragmatic partners and supporting those cedents when they're doing that kind of stuff, when they're giving premium back for unused miles that are not driven, for example?
Yeah. So I know that the Chinese regulators asked for a premium holiday, and the major reinsurers on that business were totally supportive. Most of the European reinsurers totally supportive of that initiative and supported their clients. And there was a coherence to doing that. As you say, the exposures were down. I mean, I think as this thing unfolds, I think to the extent there's a quota share, one sort of implicitly hitch one's wagon to that initiative, so that will naturally follow. It becomes a little bit more complicated on non-proportional instruments. If you're a reinsurer trading for 20 years with somebody and you've had the effects of some maybe UK changes in legislation around how liability claims are going to be adjudicated, and you got a big deficit, you might want to have a discussion, and the client might say, look, we view the excess of losses differently, because we'll view those over a longer time horizon, and we need to think about sort of profitability and other underlying issues. So I think by and large the market, from what we've seen, has been very responsive. But I do think there are some areas where the sort of immediate desire to want to sort of waive minimum premiums, for example, on excess of loss, becomes complicated, because, as I say, certainly on the liability side, and property side as well, the relationships span 10, 15 years, and there's bank and balance, and are we in deficit, are we not in deficit? And some of the classes, motor, you said, is an easy one to explain. If a car is sitting on the drive, it's unlikely to collide with anything. But Some of the other areas where exposure is a little more opaque to evaluate. You talked about claims made earlier. Things may be inactive now, but you might have 50 years worth of actions that still need to be insured. So I think it's easy on the quota shares, and I think the industry has done a very good job. On other instruments, there's a discussion to be had, and broader criteria than just looking at whether or not the exposure may or may not be down for a period of time.
Just want to ask you also, have you seen any, we've seen the nature, obviously we're talking about the nature of risk changing. For example, the nature of risk in aviation is now that we seem to have we have a hangar risk or down, we've got grounded aircraft risk. And now that with accumulations in large airports and where they're parked up, has that changed any of it? Have you seen any interesting changes in demand for, presumably that is now, is there a little spike in aviation reinsurance demand for ground risk accumulation covers and other things? So any other observations that you've seen?
I think you see it in marine. I think you see it in cargo. You see clustering. I mean, what you've pointed out is the sort of whack-a-mole nature of risk. Things might not be flying, but they're still $100 million assets sitting on the tarmac next to one another. Sometimes in parts of the world that have natural catastrophe and natural hazards. So, yeah, there is a spike. Yeah, and I think that is all flowing through as people are examining the changes in their exposure with their RDSs, and that actually ties back neatly into the recommendations we gave in our report, which is you need to start undertaking all of that analysis now to take care of all of these things and see what your capital model reveals to you in real time, and do that now rather than do that at the end of the year. So yes, the nature of the risk is changing. It is a bit like whack-a-mole, and we are seeing some concentrations in certain areas.
These are the indirect consequences of COVID-19. So like you just said, marine hull, marine cargo, ports and terminal accumulation, airline accumulation on the ground. And there's lots of instances of this where profiles are changing subtly, exposing themselves to new risks. And that's where we're having to really think through what coverage looks like and then assist our clients on that basis. And that's for every sector pretty much.
I'm going to end with a fairly generic question. This is a crisis, and a crisis is usually a time to be it's usually a great differentiator between who the best are and who the merely average and the below average are. So how are the best reinsurers differentiating themselves at the moment?
Calmness and resilience. So I think the ability to avoid a sort of knee-jerk reaction and to stimulate debate, measured debate. We saw early out of the blocks, lots of exclusion, and understandable, very understandable that would happen. But the more significant and sophisticated reinsurers didn't do that and decided to have conversations with clients and showed a willingness to have a balanced discussion so that we could crystallize on what the issues are. I mean, putting a COVID-19 exclusion on a private passenger auto physical damage quota share doesn't sound like it's particularly high on the threat hierarchy. And I'm being facetious by using that as an example, but that sort of everything's got to have an exclusion. It's understandable, but it's not sensible. And I think so. I think the more sophisticated reinsurers have created a risk threat. They've engaged with clients. They've listened to clients. They want to understand what their clients are doing to manage the risk, because they are the originators of the original risk. And I think the second thing is resilience, is to show an appetite and a disposition to want to trade through. Now, the debate around the returns they need may change. There'll be a discussion around the extent to which certain perils may need to be specifically priced for or sublimited, and there's a huge list of items that will be debatable. But I think the things that will define reinsurers will be, as I say, resilience and calmness. And I think with that we'll be able to deal with everything.
Great, and I'm sure when it's all over, we'll remember that.
We will. You're right in your question that this is where reputations in the business are made and broken. And that was true after 9/11. It was true after when opportunities were misread, when exploitation rather than a collective agreement to try and resolve something emerged. People didn't forget it, and it manifested itself in increased shares with some markets and diminished shares with others. And frankly, that moderation is hugely important, because it's what helps the industry arrive at balanced, reasonable positions. So yeah, it'll be interesting to look back. Yeah, thanks, Mark.
Thank you.
Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.